LegalZoom stock recently IPO'd, and spoiler alert, it's above the original price that they were going to IPO at. So it's currently trading around $7.5 billion, and the ultimate question is it still a good buy at this valuation? If you read the title, you'll see that I'm going to pass on LegalZoom, but it is important to understand why I'm passing on it, and you may learn a thing or two throughout this video on how I look at an S1. It may determine whether or not I want to invest in an IPO. If you're not familiar with LegalZoom, it's an online platform that connects you with legal services, as well as allows you to set up your business, whether that's an LLC or register intellectual property. It's a platform that really focuses on small business. I'm familiar with LegalZoom because I actually used their service when I was setting up my own LLC. And from my experience, it was pretty streamlined and pretty easy to use. Now, it's on the more expensive side, but I think it comes at the expense of convenience. I like to invest in stocks where I'm familiar with their product, and I like the LegalZoom experience, so I wanted to look at the S1 and the valuation to decide, hey, is this a good stock to buy? The first thing I noticed right away was that they had a ton of debt on the balance sheet versus total assets, which was a worry for me. Then you realize that's the whole point of the IPO, as they talk about the use of the proceeds will mostly go to paying down that debt. So that's good to see. Also good to see is that for 2020, they were profitable. They made around $10 million on revenues of $470 million, but they were founded in 1999, so being profitable in 2020 isn't that impressive. It's more about, can they continue that profitability and continue to grow? Based on the size of the company and that they're barely profitable, I would say revenue growth and growth is more important to investors versus the free cash flow that the company is generating. So looking at something like the price to sales ratio is important at this stage. In the S1, they claim to have a strong financial profile with 471 million in 2020 revenue. But what's weird to me is they quote constantly this Q1 2021 year-over-year growth versus Q1 2020 instead of a yearly percentage, which if you compare 2020 versus 2019 is around 15%. Looking at the full year 2020 numbers, that would be a price to sales ratio around 15.9, which if you compare versus the public software as a service company, that's higher than the 14.5 as of end of May. How do we determine if that price to sales ratio is too high? Two things I usually look at is the rule of 40 for software as a service company, and then look at the price to sales ratio divided by the expected growth rate, which in the S1, they're really pushing for this 27%, but we'll also break down that further and why I don't believe that is the correct rate to use. And even if you use the 27%, it still fails the rule of 40, which is revenue growth plus EBITDA margin. So based on Q1, that'd be 27 plus 2.7. Even if you use the 2020, it still fails with 15.2% revenue growth and 19% margins. The rule of 40, if it's not over 40, it's saying the company isn't growing fast enough, and if it's not growing fast enough, it should be more profitable. Here's the juicy part. So Q1 had a 27% revenue growth rate. In that, they say 51% increase in business formation growth, which is a large driver of the revenue. If you look at the monthly business applications from the census.gov website, you'll see a huge dip in Q1 of 2020 and then a huge spike in the beginning of 2021. So you have a dip on the comparable metric, so Q1 2020, and a spike in Q1 2021. So this 27%, I don't really think is sustainable. I don't want to be cynical, but it kind of seems like they're really putting focus on that quarterly revenue growth. Whereas if you look at a yearly basis, that should smooth out the seasonality and show more quarters of business formation and really adjust for seasonality when it comes to their earning potential. Granted, that isn't the only source of revenue. There's also subscription and partner, but transaction is around 45%. What's interesting about the subscription though is a lot of that revenue comes from transactions, because when you form an LLC, you also need something called a registered agent, where LegalZoom comes and says, hey, if you don't want to make your address public to everyone and you want someone to kind of notify you if there is a lawsuit, you can sign up for a subscription. So a lot of this revenue is attached to the business formations as well. The other part of their business around legal services and kind of being that middleman that connects the business with the service itself isn't growing that fast online. So around 4.1% is the expected compound annual growth rate through 2025 for legal services. With all that said, and a price to sales ratio of 15.9, I think a more conservative number for revenue growth would be that 15% for the 2020 versus 2019 growth. But even that is probably on the higher side because of COVID and the impact for online businesses. So 2020 versus 2019, the business should have seen some extra growth from that acceleration to online services. And the following comments throughout their S1 also doesn't help the case for me being a Super Bowl. The company goes on to say that it has a history of net losses and anticipates higher operating expenses, so they may not even maintain that profitability. With more legal expenses and being a public company, they've basically given themselves an out, as well as saying that they may actually incur large losses. I know the company, legally speaking, and it is a legal company, that they have to talk about the risks, but it's just one of those things where if you see someone talking about the profitability of this company, I just don't know if that's really sustainable. This statement is something I talked about earlier, but LegalZoom is really dependent on those business formations because that also leads to subscription revenue, and that's kind of their foot in the door with any small business as they can sell them more services over time. Here's also the crazy thing about all of these business formations. It can actually be done for free in terms of, outside the state filing fees. You can find all the forms online via government websites. Now, it's very confusing because the government sucks at presenting what you need to do. So services like LegalZoom make it really easy and streamlined, and that's what you're paying for, the convenience. Now, over time, that may put pressure on their margins as a lot of their revenue comes from something that can actually be done for free. So competitors can just undercut them. There isn't really a competitive advantage that I see. With all that out there, the price to sales ratio of being around 16 and their current valuation versus their revenue growth, which I would rather see the full year 2021 to see how they do versus 2020 versus focusing on just that Q1 information that we have. Overall though, that's why I'm passing. Hopefully you got some takeaways on my thought process of what I look for and whether or not a company may be overvalued looking at the S1. If you did enjoy the video, give it a thumbs up as it helps the algorithm, and consider subscribing to Main Street Wolf where we talk investing, stocks, anything to do with money. Thanks guys for watching and have a great day.